Over the last week, the S&P 500 heat map has been glowing green. Zoom out to the last 3 months and even year to date, most stocks are up double digit, and now the S&P 500 is sitting at all-time highs. The Fear and Greed Index, well, it's flashing greed, but here is the catch. Institutions have in fact been buying billions of dollars in certain stocks, and not everyone in fact is soaring that high. We're noticing some sectors are still battered and in fact being beaten down, and in the video today we're going to uncover 10 crashing stocks that could be next in line to explode as Wall Street keeps buying big. Now let's jump into stock number 1, and for each one we cover, we're going to highlight their recent performance, analyst rating, how much institutions have been buying, and finally our own valuation process, so you get a bit of a better picture before making any decisions. Now number 1, we have KDP, Keurig Dr Pepper, down 19% in the last year. Year to date, it's also down around 10%, and over the last 5 years hasn't had the best of performance. As we said, Wall Street are buying billions, as we will evidence shortly. Is trading near its 52-week low, quite some way away from 52-week high of $38, and while Seeking Alpha and Quant do give it a hold, Wall Street fairly respectable 4.15 out of 5. Now we typically like to look at the valuation point from a forward PE, historical versus current basis. It's trading at 14, which is much lower than the average of 19. Not only would we say severe undervaluation given the disparity, but it's also trading at a 5-year low, and on top of that you're getting a yield of 3.1%, well above the 5-year of 2.3, and also a yield at a 5-year high. Now, especially given the yield does have disparity from the historical rate, we want to flag the dividend safety score, and it does sit today at 60 borderline safe, which we will now uncover, but worth flagging, very attractive increase to their dividend just last September at 7%, which means we should be hearing in the upcoming weeks of another dividend increase. Two things as well when we hear that dividend safety is a little bit questionable. Firstly, what does the free cash flow payout look like? As always, we draw your attention to that over the earnings, which is susceptible to manipulation by management through accounting, and for this industry we want below 70%. Now 76 in 2024, little bit on the upper end, the same on a trailing 12 month, but nice to see, especially if they can execute on this, that it is anticipated to come down to 47 in the next 12 months. Couple that metric with the net debt to EBITDA does really give us a better picture of the dividend safety. Now numbers you see below are the number of years it'll take KDP to pay off all of their debt net of cash on hand. We want below 4. Remember, this also correlates not just to dividend safety, but balance sheet strength, sitting at 3.71, so right there at the upper end, but anticipated to come down over the next 12 months. Just something to consider about the yield. And the other valuation point here is looking at the blue tunnel. Now remember, within the parameters here is the fair or intrinsic price. We're seeing it not only at severe undervaluation given the disparity from the bottom end, but this one actually for the majority of the last 12 months has been trading in the undervaluation point. When we zoom out to the last 5 years, we get an even clearer picture. From 2020 to 2022, we see it trading in a reasonable signal. Actually, since 2023, this one has been trading at quite an attractive valuation. Today does sit at one of those points that we would say is one for serious consideration. And in terms of the growth, because we want to understand with each one of these companies what are realistic expectations, they get a B minus, pretty much revenue year on year, and expected this year to be increasing in line with inflation. Now yes, nice to see it is above the sector median, but actually it's growing a little bit slower than it has done historically. The other metric to note here is the earnings per share over the next 3 to 5 years. They're projecting around 8%, nice to see above the sector and pretty much in line with their 5-year. And institutions holding a lot, in fact 94% ownership, where they sold 3.6 billion, we're talking in the last 12 months. They've bought nearly 3 times as much in the same period, and we've seen in the most recent quarter a lot more buying than selling, 2.7 billion buys versus 540 million sells. So definitely very bullish. They are net buyers, and if you wanted the reversal of this trend, well, you'd have to go to Q4 2022, really the only time we're seeing in the last few years where institutions were selling more. So very bullish indeed. Now with each one of these companies, we're going to discuss our own intrinsic price. For KDP, it comes to the average of the four that you see on screen of $36. And when we do our deeper dives on this channel, we do run through every single one of these models, talking about the inputs and outputs. The only thing we will flag here is, for those that just want to see a discounted cash flow valuation, baked in right now is around 10.9% growth. Maybe something you want to take away if you want to have a look at your own investment thesis. But when we look at all four models, as of today, you're getting a 20% margin of safety. Now remember, on the channel we do typically kick off with 10%, execute buy essentially if it meets the three golden criteria: wide moat, strong financial metrics, good forward-looking data. Keurig Dr Pepper, 20% margin of safety or thereabouts. If you want to see it 25, well, at buy at $27. And Wall Street, very bullish. Institutions are loading up. Wall Street with a respectable buy rating we mentioned earlier, $39 into next year, 34% upside. Stock number one, Keurig Dr Pepper, let us know your thoughts. And before we continue, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox, completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away. We'll also be able to gain access to severely undervalued stocks for the month, lots of information for each one, the upside that Wall Street themselves see over the next year, and we will be releasing September's copy in the next few days. And on top of that, you can grab a spreadsheet of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move into the railroad sector with UNP down 12% in the last year. Over the last 5 years, this one not the greatest, up only 13%, but is trading very near to its 52-week low, where we get a double buy this time from Seeking Alpha and Wall Street. A forward P of 18 that sits below the 5-year of 20, a yield that's higher, 2.5 versus 2.2. Remember, this is a double undervaluation signal, with a nice 80 score on the dividend safety, although not the most impressive increase to the dividend just last month at 3%, which is what we would say below the historical 4% inflation, and nice to see another undervaluation signal slightly below the bottom end of the blue tunnel, although this one more often than not does trade in a reasonable signal. Zooming out to the last 5 years though, there was maybe 1 or 2 opportunities where you could have got this severely undervalued. Remember to subscribe and have the notification bell on. High quality companies, when they're severely undervalued, we will make you aware. Now the growth on this one is a little bit mediocre. We're talking 1% last year, 2% expected this year, which in all fairness, it is below the sector, but not that far off their own historical, so don't expect these numbers to suddenly jump in the short to medium term. EPS projected around the 9% mark, not too far off both sector and their 5-year, but a little bit lower. Institutions, they hold 81% ownership, selling just under 10 billion in the last year, buying over 18, so nearly twice as much, and they've also bought nearly twice as much in the most recent quarter. Now, reverse of the trend for quite a significant distance, you would have to go to Q1 2024, so definitely in the shorter to medium term, institutions have been very bullish. Now, our intrinsic price, $247, does give rise to a 10% margin of safety, again solely focusing on the DCF model that does pretty much come around. The average intrinsic price is flagging 7.8% baked into the free cash flow today. If you like the company but want a larger MOS, well, at 20%, a buy just under $200, and at 25%, we're talking $185. Wall Street themselves, $268 is where they see this into next year, 22% upside. Let us know, UNP, if you see it as a buy, hold, or avoid. We then move into the pharma space with Regeneron down 52% in the last year. In the last 5 years, they're also down around 4%. We can see all-time highs. You'd have to go back pretty much a year ago today at $1,200 and also trading around 52-week lows. Now we get another double buy from Seeking Alpha and Wall Street, and on a valuation perspective, forward P15, that is below the sector of 18, so you are getting an 18% discount. You're also getting a little bit of a discount, around 11%, to what they've historically been valued at. And for those that want to incorporate growth, well, on a price to earnings growth basis moving forwards, 1.89, pretty much in line with the sector. And we get a growth here of an F. We're talking last year 5%, this year expected around 4%. That is slightly below the sector, but actually quite some way below their own historicals. They were typically growing around the double-digit rate. EPS though looking promising at 8%. Yes, it is below the sector at 11%, but higher than they have done before at around 5.3%. And institutions with their 83% ownership selling $9 billion, they've bought more at $13 billion. They've also bought twice as much in the most recent quarter, $3 billion versus 1.5 sales. And the reverse of the trend, you'd have to go Q3 2023. So they've actually been bullish for quite some time. Now our valuation gets to $882, giving rise to a 35% margin of safety. Now what we've done here, solely the DCF model, as it is the most appropriate for the company. We have the free cash flow year on year. Growth rate on average, 35%. We've gone a lot more conservative at 6%, although you can see low, medium, and high, 2, 6, 10. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for REGN or any others. Now, based on 6% and the discount rate, we get the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, giving our intrinsic price 53% upside. Now, if you want to see what's baked in, pretty much no growth currently. So if you are buying this company today, that is where the market sees it. But if you believe this number, in fact, is too optimistic, you want to be more conservative at 2, 6, 7, 3, 70% upside. And if you believe these numbers are way too conservative, well, at 10%, pretty much at its all-time high, indicating a double from today's value. As always, we take through the middle rate of 6%, which we flagged already, 35% MOS. Wall Street, very bullish. They see this 760 into next year, 32% upside. Do let us know on Regeneron Pharmaceuticals. We then move into the software space with Salesforce down 24% year to date. Over the last 10 years though, this one has continued to outperform the S&P, trading very close to 52-week lows. Double buy from Seeking Alpha and Wall Street. Wall Street 4.38, very near 4.5 for a strong buy from them, where we also notice a forward P of 22 below historical 31, a safe score in the dividend of 80, and an undervaluation signal when we do look at the blue tunnel. Now we have to make you aware though, it is decreasing, not something we typically want to see. We want the intrinsic price over time to get higher and higher, and we can see when we zoom out, it did pretty much peak in the mid to end of 2024, and for quite some time, this company has traded well below its intrinsic price, something we are seeing again in 2025. Now their growth at a C, we do notice last year they grew 8%, actually expected to increase that this year to 9%, which is above the sector, but quite some way below their own 5-year. This was a very strong growth company historically. Earnings per share though, still looking very decent, 17 to 18%, above the sector, a little bit below their historical 20%. And institutions, 81% ownership, selling 28 billion, buying a lot more at 43, also buying around 50% more in quarter 2, 11 versus 7 sales, and reverse of the trend, you'd have to go to Q3 2023. So another one institutions clearly are in favor of. And our intrinsic value at $371 is using a growth rate of 8%. Baked in, we're only talking 2.6%, so it already does look pretty undervalued, but maybe you disagree and you think this one will increase it at a much slower rate. For those who are a lot more optimistic, at 12%, we're talking a near double, but using the middle rate, you're still getting a very respectable 32% margin of safety. Wall Street, near strong buy rating, institutions buying billions. They note this 38% upside, $350 projected price target. As always, let us know on CRM. We then move on to Sanofi, down 11% in the last year. Over the last 5 years, it is pretty much flat, trading towards the lower end of the 52-week range, but a very respectable double buy rating from Seeking Alpha and Wall Street, 4.2 on both accounts, and a forward PE slightly below the 5-year average, but the yield does look strong, 4.4 versus 3.8. A very safe dividend score at 90, with around an inflationary increase at the beginning of the year, and we also get an undervaluation signal. It is slightly slightly below the bottom end. Something that we have noted though, this is one that very rarely enters into a severely undervalued territory. We can see clearly this noted though in mid 2022. Now the growth gets an A+, last year double digit 16%, this year expected a slowdown to 6, which we can see the sector very consistent around the 7-8% mark, their own 5-year actually a little bit lower, so they are growing at a slightly faster pace. Earnings per share projected 11%, pretty much in line with the sector, but improvement from their 5-year average, where institutional ownership is low at 14%, 2.3 billion worth of selling, a little bit more buying at 2.4. However, the most recent quarter we do see a little bit more selling than buying, but that is opposite of what we noted in Q1. And our intrinsic price gets to $66, giving a 26% margin of safety. Now, if you wanted to know on a reverse DCF, whilst we have used 4% for our actual model, baked in now is pretty much no growth, leading to around $65, not too dissimilar from the average. Wall Street also like this. We did get a double respectable buy rating, $63 from institutions, projected 29% upside. We then move into the Coca-Cola company. Now, yes, this one isn't as badly battered as the others. It's only down 5% in the last year. Against their own 52-week high though, it is down around 10%, but we've included it. Institutions are buying billions. It is one that has been heavily requested, and over the last 5 years, it's up around 38%. Over the last 10, we're talking around 78%. It's also got a strong buy from Quant, a near strong buy rating from Wall Street, although we can signal here a hold from Seeking Alpha. Forward P is also slightly lower, 22 versus 24. Yield pretty much in line with their historical at 3%. A nice 80 dividend safe score with an increase early in the year of 5.2%. And probably no surprises to note here, pretty much in a reasonable signal, something noted in the last 12 months, but also something we note when we zoom back to the last 5 years. Really, if you wanted this in severe undervaluation, it would have been the back end of 2023. More often than not though, this one does trade within the blue tunnel parameters. Now growth sits at a C, very disappointing last year at 1%, projected to increase around inflation at 4% this year, slightly above what we noticed from the sector, but actually they're growing marginally lower than they have done historically. Earnings per share, well, it's projected around 6%, pretty much in line with both sector and their own historical. Now, institutions, 71% ownership, selling 18 billion in the last year, buying a lot more at 28 billion. They've bought twice as much in the most recent quarter, and we can see they're continually very, very bullish. You'd have to go to Q3 2023 to note the opposite. Now, our intrinsic value gets to $71. Now, we only see around a 4% margin of safety currently. If you wanted larger at 10%, a buy at 64, at 20 around 57, and at 25 around 53. Wall Street, they're in disagreement though. They see this one going much higher into next year at $82. They see 21% upside, and they believe this is definitely one for serious consideration. Do you agree, or maybe one you believe to avoid? We then move on to Constellation Brands, down 34% over the last year, down 15% in the last 5 years. Over the last 10 though, it is up marginally 25, trading pretty much at its 52-week low. Bit of a traffic light system, sell from Quant, hold from Seek Alpha, respectable buy rating from Wall Street at 4.12. Now their forward P sitting at a 5-year low, 12 versus historical 20, yield at a 5-year high, 2.6 versus 1.4, which then makes it great to see the safety of 70, but we do have to make you aware a very low disappointing increase to the dividend in April at 1%, and no surprises given what we did just run through, another severe undervaluation signal. If we actually zoom out to the last 5 years though, this one was trading within a reasonable parameter. However, it did start to dip pretty much at the back end of 2024, hence why we see this very large disparity. Now growth not looking great, we're talking negative 1% last year, expected the same this year, but doesn't mean it isn't a company we should consider, especially if you're looking for a value play, although we should make you aware the sector is expected to grow faster, and their own 5-year does sit around the 4% point. Earnings per share also disappointing, projected only 4%, lower again on both accounts at 6 and 8% respectively. Institutions though holding 77% ownership, selling 6 billion. They've bought more at 8 billion in the same time frame. They've also bought around 50% more in Q2, but you'd have to go to Q3 2024 to see the reversal. Now our intrinsic price at $203 does already give rise to a fairly decent 22% margin of safety, Actually, if you solely want to use the DCF model, the price would be slightly higher, where we use a growth rate of 7%. Baked in though right now 3.7. Now some investors may already believe this is too high and therefore not one for consideration, but on average we are noting a 22% MOS. If you wanted 25, a buy at 153, and if you wanted to go one step further at 30, 142. Wall Street, they like it. 204 into next year, 28% upside. Is this one that is now due a turnaround and one to consider? We then move on to Zoetis, down 15% in the last year. Over the last 5 it's down, but over the last 10 it has outperformed the S&P, trading near 52-week lows. A strong buy from Seeking Alpha, a buy from Wall Street with a hold from Quant. Another forward P at 24, 5-year low against the 5-year average of 32. Yield 5-year high 1.3 versus 0.9. A respectable dividend safety score of 74. And we note here a strong double-digit increase to the dividend of 16% in December last year. And no surprises, we are getting a severe undervaluation signal, something noted pretty much from the beginning of the year, whilst the blue tunnel for the large part has been increasing slightly. And over the last 5 years, this is one more often than not does trade around an undervalued position. Now growth does let it down at a D-. We're talking 5 to 6% year on year and projected this year. It's lower than both sector and their own 5-year average, although we do have to say only by a few percentage points, with earnings per share also expected lower, pretty much similar conclusion, 9% versus 11% on both comparatives. Now institutions hold 93% ownership, selling $10 billion in the last year, buying 50% more. They've also bought a lot more in the most recent quarter. If you want the reversal, then we note Q1 they actually were selling a lot more than buying. In our intrinsic price, $210. If you want the DCF, a little bit lower, we're talking marginally. Baked in though is 10%. Some investors may believe that is a little bit too high, but on average we're talking a 27% margin of safety. If you wanted 30, a buy around 147. Wall Street love this one, 210 into next year, strong upside of 37%. Let us know Zoetis a buy, hold or avoid. We then move on to Next Era Energy, down 9% in the last year. Over the last 5 it's up marginally. Over the last 10 though, similar to the previous company, it's outperformed, and we see it trading around the mid to lower end of the 52-week range. Double buy from Seeking Alpha in Wall Street, a forward P below 20 when the historical's been at 25, yield looking good, 3.1 versus 2.4, and another very safe dividend score at 90. They also increased the dividend 10% this year, and we get to see a severe undervaluation signal, something constant in the last 12 months, but actually when we zoom out to the last 5 years, pretty much noted from 2023. Now growth does come in at a C, we're talking no growth in fact year on year, expected 4% this year, which is in line with the sector, but actually historically they've grown at a much faster rate. EPS, good to see, 7.3%, which is pretty much in line with the sector overall, a little bit lower than their own 5-year, but another institutional favorite, 79% ownership, sold $8 billion, bought twice as much in the last 12 months, also buying nearly twice as much in the most recent quarter. If you wanted the reverse of the trend, then you would have to go back quite some way away. We're talking pretty similar in Q4 22. Q3 again, very similar case. Now our intrinsic price gets to $83, giving rise to a 13% MOS. Wall Street see this $85 into next year, 18% upside, a 20% MOS, a buy at 66, and at 25, $62. Next Era Energy, let us know your views. And then we move on to FedEx, down 22% in the last year. Over the last 5 it's up marginally. Over the last 10, bit of a roller coaster, up 56%, trading towards the lower end of the 52-week range. Double buy from Wall Street and Seeking Alpha, where we notice the forward valuation not too dissimilar from the average. Yield is higher though, 2.5 versus 2, and they've got a 64 safe dividend score, increased just above inflation at 5% this year, where we also notice a reasonable signal, although the blue tunnel has been decreasing ever so slightly, and growth not the best, C-, flat year on year, 2%, again below inflation expected this year, below both sector and their 5-year at around the 4 to 5% mark. EPS projected 11%, pretty much in line with both comparatives. Now institutions institutions, 85% ownership, selling $6 billion in the last year, buying 50% more. They bought 3 times as much in the most recent quarter. Very, very bullish, and the reverse of the trend by quite some distance. You'd have to go quite some way away, in fact, before 2022. And our intrinsic price gets to $274. Remember, as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, FedEx or any others. You're getting a 16% MOS as of today. At 20%, about 219. At 25, around 205. Wall Street themselves see this 285 into next year, upside of 23%. Let us know your thoughts on FedEx. Maybe you like it, maybe you prefer UPS, or maybe neither suit your portfolio. Don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us on Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.